Well, are tariffs coming? Well, they might be. And if you are about to be retired or already retired, at some level, you're probably concerned about it. What will the impact be to your cost of living, inflationary pressures? What about your retirement portfolio? And what about the general economy? So it's a valid concern. And in this video, we're going to talk about the impacts potentially of tariffs. We're going to talk about what portfolio managers and economists are saying right now. And then we're going to talk about specific strategies that you need to be thinking about for your own retirement portfolio. Now, the slides you'll see on the screen, if you want a copy of the slide deck, just go to the show notes. There's a link. Just click that link and you can download the slide deck for review afterwards. Okay, let's get into it. Now, the first thing we need to acknowledge is we've been here before. So we can go back to 2016 in the first Trump term, and there's some clues from the decisions they made back then that we could use to provide insights for the current administration's policies. Now, as we get into this presentation, one of the challenges is Trump is so polarizing. So there's a visceral reaction to him on both sides of the coin. And what we need to try to do is to push past that aspect of Donald Trump and just look at the policy positions and talk in practical terms what the impact is, and then how do we respond to that impact. So my goal for the presentation is to help you step back and have a broader lens through which you can look at the impacts and the policies that might be coming our way. That's really the most important part of this goal. Now, what I'm going to do is, first of all, just talk about how the U.S. has used tariffs historically to give us a little bit of a context for what's going on right now in the U.S. Now, over the last 100 plus years, the United States has used three types of tariffs for different policy outcomes. So the first area has been revenue or fiscal policy tariffs. And in fact, in the early days of the United States, and many countries were like this, they would levy tariffs of goods coming into ports. So before they got shipped off, there'd be a tariff paid. And that's how a lot of federal governments in the U.S. Federal government raised revenues to support what it did. That was very common. Another form of tariff would be protecting domestic industries, restrictions around that. So again, that's been a common use of tariffs. And then the last area is reciprocity or reciprocal tariffs. You cut your tariffs, we'll cut ours. And ultimately that tariff back and forth battle leads to free trade agreements. Now, the area that I want to focus on in this particular presentation is revenue fiscal policy tariffs. Now, what's unique right now about the Trump administration is they're actually using all three of these tariff ideas. At least they're threatening to use all three. And if that does happen, that's actually quite unique if you look at the history of the United States. But let's just talk about the fiscal tariff area first, because that's a very interesting one that's not getting covered in a lot of detail in the popular press and media with very short sound bites. But it's an important one to be aware of and to understand the background to. Now, the next part of this video is probably the most important as it relates to understanding the motivations of the Trump administration to impose tariffs. Why out of the gate are they so aggressively talking about this and may potentially implement it? What's driving those decisions? Because when you hear the prime minister talk and premiers and pundits, some economists, what they're going to say is this doesn't make any sense. It's going to inflict pain not just on Canadians, but on Americans. So there's going to be tariffs imposed. The Americans will, consumers and manufacturers will pay higher costs because of that. There'll be reciprocal responses by other countries. Canada will impose tariffs. And so there's going to be cost pain or economic pain for the U.S. It just doesn't seem to make sense. But we're going to cover off some Economics 101 that doesn't get talked about in any of the press coverage really. But it's really important that we understand what the Trump administration is gaming in this particular circumstance. Now, the slide that you see on your screen is just looking at the U.S. dollar over an extended time period from 1975 right through to now 2025. And what you're beginning to see is some recent price appreciation. Now, we'll talk about this later on in the presentation, but currency markets and stock markets and bond markets are always pricing in all known and expected information that could potentially impact their valuation levels. So what in the world are currency markets gaming right now about the US dollar relative to other currencies? So let me take you through sort of Economics 101 in terms of what potentially could happen as a result of tariffs and why the Trump administration may not be concerned the way that our politicians are talking about it. So let's just do a thought experiment. The Trump administration imposes tariffs. Because of that, it's going to create economic hardship on Canada, Mexico, Germany, let's say, the UK, countries around the world. And a lot of countries in the short term don't have a lot of things they can do to respond to those tariff increases that are immediate. But one of the things they will do is they'll enact both fiscal and monetary policy to try to get through that tough period. So fiscal policy is government tax policy and spending policy, and monetary policy would be what's the Bank of Canada or Bank of England going to do. And one of the things they will likely do is push down interest rates. Now, historically, when you look at central banks that do that, they're always worried about when they push rates down, what will that do to their currency? Because relative to interest rates in the UK or Canada, where are interest rates in the US? Now, we're not likely to see some dramatic moves of interest rates going down in the US, at least in the short term. So this is what likely is going to happen. Interest rates in Canada or the UK, as an example, will go down. The central banks will respond to try to support their economies doing that. But currency markets will respond differently. If I'm getting a lower interest rate in Canada or the UK or other jurisdictions, then you'll begin to see a selling of those currencies. So you'll see a selling of the Canadian dollar, and you'll start seeing some price depreciation. Now, what begins to happen, and this is what the Trump administration is gaming, is that all these central banks respond to these tariff increases by reducing interest rates. The US dollar will be trading higher relative to those other currencies. So the net effect of that is, as the US consumer and manufacturers are importing goods and services, they're able to buy more of those goods and services because the US dollar is stronger against those other currencies. So the Trump administration is thinking, well, we know that the tariffs potentially could have a negative impact, but we think that the US dollar will strengthen, which will allow the US consumer and manufacturers to have more purchasing power that will overcome the negatives of those tariff increases. So that's the first thing we need to keep in mind, is that U.S. Administration right now is thinking that that will be potentially a ripple effect scenario. It's not perfect, but the U.S. dollar is the global reserve currency. There's always going to be a demand for U.S. dollars. And in an uncertain economic environment where there's tariffs, you're probably going to see some downward pressure of other currencies. That's going to work in the U.S.'s favor. Now, the second reason is a critical reason, and that relates to the fiscal health of the United States. Well, I hope you're enjoying the video. By the way, if you're serious about retirement planning or want a second opinion, go to the show notes. There's a link back to our website where you can find out more information about our gap analysis, as well as accessing our free retirement planning resource bundle. So let's talk about the real reason for these tariffs. And the real reason is money. So the U.S. Is just a basket case fiscally. And when it comes to getting budgets approved in Congress and the back and forth, it's just a very difficult process. And any president has somewhat limited ability to kind of influence that process and where money goes. Now, there's an exception to that rule. Now, if you are the Trump administration and you're wanting to maintain tax cuts to the middle class, you want to introduce further tax cuts corporately, as an example, and you want to engage in other spending priorities that your administration thinks are important, where are you going to get the money from? Well, one workaround is in the whole area of tariffs. So the Trump administration, as you can see, is enacting policies that could potentially put a lot of money in the U.S. Treasury, and the administration has a lot more control about how that money gets spent and what the priorities for that money will be. So again, if you just follow the money in terms of these transactions and the really motivations behind it, it's about quick revenue generation, filling up the war chest, right, the U.S. Treasury, and having flexibility about how you're going to spend that money. Okay, so those two areas right now, their belief that they could probably do this and limit the collateral damage to the U.S. consumer manufacturers, and the fact that it's a quick way of raising money to pursue other priorities, those are some core motivations that are happening behind the scenes for the Trump administration. Now, the question is, how are the markets responding? It's kind of interesting. This chart that's on your screen is the S&P 500, the broad U.S. stock market. And you can see back in November, after the election, the markets actually rallied. We saw a bit of a rally through December. And so the markets generally, the animal spirits of the market, like Donald Trump. You can see that in the small business sentiment index. small business owners are sort of pro-Trump in terms of what they think will be a positive influence on the business sector. But in general, you can see the market's been trading sideways. So if things are so negative, why isn't the market corrected? A lot of clients have asked me that question. And what I would say is markets will price in all known information, but they can't price in unknown information. They can't fully price in what is at this point speculation about what the Trump administration will do. And the market can misprice some of the information as well. But obviously the market is gaming a certain probability of outcomes. And I'm going to cover that off for you. Now, before we look at a chart that looks at the probability of outcomes, let me just go over a few bullet points that are worth considering. So the belief is this. First of all, at the end of the day, Donald Trump does not want to intentionally hurt the economy. Now, that doesn't mean he's not going to try to exploit this tariff strategy to raise money, but he's going to be looking at the ripple effects at the same time, likely. He's likely using tariff policy to extract maximum leverage in negotiations. And he does care about the stock market. And we can see that, again, going back to his first term, when some of the strategies were hurting the market, he began to pivot in the opposite direction. And so the market believes that he's likely to do that again. He has many business leaders surrounding him. If you go back to the inauguration, you had the tech titans, you had business leaders, lots of billionaires. He positions himself as a populist. But at the end of the day, he's going to listen to the business leaders that are around him, and that will influence how he's going to approach some of these policies. And in particular, he doesn't want higher inflation. So tariffs create not so much inflation that's systemic, but it does increase potentially the consumer price index if prices go up. Like I said, a higher US dollar might reduce some of the effect of that, but he definitely doesn't want to see sticky price inflation. He's always sort of balancing off the economic reality and the political reality so he can stay in power. Now, these are really important components because they influence some of the consensus opinion. Like I said, let's take a look at that. Now, this is a great slide that synthesizes the opinion of portfolio managers and economists on the likely scenario. So if we had to go through the scenarios, you've got North American focused tariffs, substantial but temporary tariffs, partial tariffs, no tariffs. Now, right now, this information sort of jives with where the market's at, that previous slide that I showed you. So the highest weighted average right now or likelihood is partial tariffs, 45% chance or likelihood. Smaller tariffs on targeted sectors and countries. Now, the next category at 25% is substantial but temporary tariffs. All right, so we could see larger tariffs on Canada, Mexico, China, but that might migrate down to partial tariffs. And this gets back to the discussion on the negative economic impact. So if the Trump administration begins to see cost inflation, if they begin to see a negative market, and they see negative economic numbers, there's a very strong likelihood that they're going to pivot away from these strategies and become more targeted to certain sectors. So obviously, if they went to a North American-focused tariff strategy of 25%, it's going to have massive impacts on Canada and Mexico. But right now, the market's gaming that that's not a likely outcome. Now, we could see some high tariffs initially, but likely we'll see a movement to partial tariffs within several months or a few months, depending on what the impact might be economically. So I wanted to show this slide to you because this is the kind of information that the market is gaming. It's one of the reasons why we're not seeing, massive volatility in the market is because obviously we're not sure yet, but the thinking is a probability will be probably partial tariffs at the end of the day. And it might be a mixed pathway to that between higher tariffs and then a reduction in tariffs at some point. Now, let's turn our attention to the economy and the stock market. And so again, if we take a look at this dashboard, it's a very instructive dashboard to give us an idea of both the positive and the negative forces that are acting right now. So on the left-hand side of this chart, you can see overall policy effect, and we've got tariffs, immigration, regulation, oil policy, taxes, animal spirits. And again, we put that there because the markets like Trump. Whether we like Trump or not, the markets generally see the Trump administration as positive for business, government spending, debt servicing. Now, the green areas of this chart, now we're looking at the short-term economy. Okay, we're not looking at the stock market necessarily, but we're looking at the economy. The overall effect gleaned by economists is positive. And the reason for that, whether we agree with the policies or not, the reason is we're going to see massive deregulation, right? So that does unleash some economic activity, and so that's a very big focus of the Trump administration. Number two, the Trump administration wants to get energy costs down. Now, the practical reality is that really plays into Canada's benefit. So contrary to all the rhetoric, the Trump administration does need Canadian energy to successfully pursue their policy positions. So it's another reason why we think that some of these policy pronouncements around tariffs are more about leverage, because if you look practically at how they're going to achieve their policy positions, particularly around energy costs, they need Canada. Taxes are going to bring down corporate tax rates. I've already talked about their strategy for filling up the war chest again in terms of using tariffs for that. And so in general, economists and portfolio managers think that the policy positions, whether you like Trump or not, will be good for the short-term economy. Now, if we go across to equities, we just look at the stock market. Now, I guess this is more specific to the U.S. stock market. The overall effect is deemed to be positive. So again, deregulation, lower energy costs, lower taxes corporately, and an administration that's pro-business, the market will just view that as a positive net for sure. Now, in terms of inflation, the view is that probably we'll see some inflationary pressure. In fact, this is one of the big challenges for the Fed, central bank in the States, is we thought that we might see some continued rate reductions in the States. That may not be the case, at least in the short term, because there might be some sticky price inflation down there. If we look at the medium-term economy right now, the consensus seems to be about neutral. In other words, these policy positions are positive, but we could see debt servicing being an issue. We could see tariffs being an issue, right? So it's kind of not a net overall positive. It's more of like a neutral. But if you're looking short to medium term, both from an economic standpoint and a market standpoint, the market seems to be, saying, in general, we're cautiously optimistic. And that's where you're seeing the market sort of trending sideways at this point. Again, it's no guarantee the market's not going to correct, no guarantee that the market's going to move higher, but these are the opinions of those that follow the topic in a lot of detail. Now, when it comes to Canadian tariff considerations, again, just a few points to emphasize. A sustained blanket 25% tariff is unlikely, as we said before. Here are some of the reasons why. Again, it's a negotiation ploy, likely. It is used to achieve other aims. Okay, so in the brackets here it says border security, etc. We think that really the biggest aim is a revenue generator in the short term. There could be reciprocal damage with tariffs, so that is reality, and the Trump administration will pivot if that's the case. And for Trump to reduce U.S. energy costs, he needs Canadian oil. He can't really subject to a big tariff, and so that's going to restrain some of his inclinations in that area. And it's going to be really next to impossible for the U.S. auto sector to function properly with a fully integrated North American supply chain. Okay, let's take a look at the probable Canadian tariff responses. Now, before we get into the detail of this slide, it's really important that we remind ourselves that this is not a toggle switch. This is not a black or white kind of situation. This will be a very nuanced, tactical, evolving situation. Now, initially, there could be some dramatic tit for tat that'll go on, but there'll be some adjustments along the way because of the things that we've already talked about in this video so far. So tit for tat response via Canadian tariffs for sure. And in fact, the initial responses will be likely at the same magnitude as the U.S. tariffs. Okay, but Canada can't win that game. They're going to need to, I think, pivot pretty quickly to a more nuanced, targeted tariff response. Initially, from a political and patriotism standpoint, we're going to have to do the same magnitude. But then I think cooler heads have to sort of prevail, and we have to realize that we just can't go toe-to-toe with the U.S. on that kind of approach. So a more nuanced approach would involve targeting U.S. sectors that meet the following criteria. So criteria number one is politically sensitive to Trump. So some logical things might be, are there sectors in red states where he gets a lot of political support that we can inflict some economic pain through tariffs. Where Canadian demand is highly elastic. So that's putting tariffs on goods and services coming from the States where the consumer has demonstrated they can pivot to not purchasing that product. It may not be an essential product in terms of their month-to-month, year-to-year expenditures. And where there are viable non-U.S. substitutes, right? So Canada does have some room to maneuver as it relates to those particular categories. Now, when they negotiate with the U.S., they may make concessions. There's some wiggle room here, right? Whether it's border security, defense spending, the digital services tax that's been in the news quite a bit, Canadian protectionism, the supply management industry, softwood lumber, scope for Canada to commit to additional U.S. goods purchases, much like China. So there's a lot of areas that can open negotiation and frame some eventual agreements. Again, the speed at which some of the things will happen will be somewhat dependent on the actual economic impacts of Trump's tariffs on the U.S. So as I said, they have a very clear mandate, although it's not talked about in the media a lot. They want to generate revenue, fill the coffers, try to push that as long as they can until they see some collateral damage to the U.S. economy, and then they'll probably begin to pivot at that point. Now, although we think that the tariffs being higher for longer is a lower probability situation, we still need to talk about the economic impacts on Canada and all of us, because that ties into our budgeting and our investing for sure. So that particular scenario would be obviously risking growth in the country, investment in the country, and overall financial stability. The potential hit to GDP would be 2.5% downward spiral. That's horrendous. And short-term cost increases for both businesses and individuals or consumers would obviously be a big issue in groups that are already squeezed from a cost standpoint. And then, of course, the last one is increased risk of recession. Now, the knockoff reaction by the Bank of Canada, as an example, is lowering interest rates, which for borrowers would be a positive thing, obviously, which for bondholders, we'd see maybe some price appreciation on bonds as rates come down. But as it relates to our currency, we'd see our currency fall, as per the discussion earlier on, where we'd see some downward pressure on the dollar as our interest rates are less competitive. We'll see a flow of money to the U.S. as an example. So one of the things we need to be mindful of is building a plan that contemplates these kinds of risks, and I'll come back to that in a second. Now, this slide is not a promotion of China, but it's very instructive. Now, this may come across as a little bit political, not meant to be. I think whether it's the Liberal government led by Carney, it seems that he's probably the foregone winner of the Liberal race, or Pierre Poilievre, the reality is we're now in a situation from an economic standpoint where we didn't have to be here. We're very under-diversified, obviously, in terms of our economic strategy in this country. This is China. And you can see in this chart, if you looked at Chinese export orientation over the last 12 months, you can see that 48.3% of their trade is with Asia, 20% roughly of their trade is with Europe, and 16%, although it's a large percentage, we keep thinking about the hit that China is going to experience with tariffs. The U.S. is 16% of their overall trade. They've done an amazing job of diversifying their trade relationships around the world. And where this is instructive, we can't fix the problem in the short term, unfortunately. But we really need to get our act together as a country. And I think as you're talking to your political representatives, and if you're the kind of person that weighs in on policy decisions, we need to figure out a way of getting, oil out to the coasts and getting world prices for our commodities. We need to rely less on our relationship from a trade standpoint with the U.S. And we need to find ways of recalibrating the energy sector in our country. We have ethical energy. We have some of the best carbon capture technologies in the world. We should be a resource to the world in terms of the greening of the world through great technologies in non-renewables, which we're not going to move away from anytime soon. So rather than being positioned as a scourge, we are a solution. And we should also, on top of that orientation, not just build out the energy sector, but also trying to find ways of breaking down interprovincial trade barriers. So there are things we can do so we're never in this situation again where we're economically handcuffed and at the mercy of one particular political entity that all of a sudden wants to make things difficult for Canada and the rest of the world. So at this point, the big question is what to do. What are your next steps? How do you look at your own retirement planning? Whether you're just about to retire, already retired, what are the action steps that you need to put in place in your planning to deal with some of these issues? Well, the first thing that you need to do is to step back a little bit. I said at the beginning of the presentation, I hope that this information will give you a bigger picture perspective on what's going on. This is not black or white. It's not a toggle switch. Don't allow the headlines to drive your decision making or how you think about things. And I think at the end of the day, it's probably not going to be quite as dramatic as it's being positioned. There will be some ebbs and flows. There's going to be some drama along the way, that's for sure. But I think the narrative that we've given you in this presentation is that there'll be some specific things that Canada can do to respond, that Trump doesn't want to see negative markets. He doesn't want to see increased costs in the States. He does listen to business leaders there, and that's going to constrain some of this rhetoric around Canada, around tariffs, and around the direction that they're taking in this whole area. So that's the first thing to think about. The next thing is we need to think about, is there information out there that can sort of be a counterbalance to all the negative stuff? And I'll actually cover a few slides that might help in that area. And then finally, I'm going to talk about some first principles that you should be using to fortify your situation against geopolitical volatility and economic volatility. So let's take a look at that right now. So the first thing we need to do before we get into first principles and constructing a plan that will help you deal with just the natural volatility and vicissitudes of markets, economies, and geopolitical events is take a look at this chart. The best and worst trading days, it says happen close together. This is the S&P 500 U.S. stock market index between 1988 and 2019. This is fundamentally a crucial chart for you to be aware of and to take into account when you're constructing your own planning. So the daily volatility of the market from 98 to 2019 is represented in this chart. And when you step back and look at it, what you see is every single day is volatile. And there's some days that are more volatile than others. And in short periods of time, it's virtually impossible to figure out really which direction the market's going to go in. So this is why, as retail investors, it's absolutely impossible to time the market. You do not know which way it's going to go. And headline news and pundits are not going to give you clarity. Nobody knows the future. So if we don't know the future, we go through this kind of volatility, we need to have a framework to work within. Now, if you look at this particular chart, not only is there daily volatility, that is markets bouncing around all the time based on short-term information that's coming in, and geopolitical events, which we'll talk about in a minute, but the best days over this time period in the green and the worst days in the red are bumped up right beside each other. And that's a little bit different than what a lot of people think. They think that we go through some negative days, then things stabilize, and then eventually they start getting better. And that's not how it goes. It's basically the best and worst days are all happening within the same time frames often. And that's why most retail investors over time underperform, because they're trying to be tactical to try to step around these periods of volatility. And the longer you're in the market, the more there's a chance or probability that you're going to get it wrong. It's just not a productive strategy. So that's the first thing is you can't time the market. There's lots of volatility. Volatility is just a reality as investors, as retirees, and we need to have a process to deal with that. Now, the second thing is market geopolitical events are just a constant. Now, we've been doing this for over 30 years, and we've been working with clients through numerous market events, geopolitical events, and we haven't had any clients unretire. We've had clients successfully navigate these events. The Gulf War in 91, Asian financial crisis, the Russian financial crisis, the dot-com bubble burst in 2000, 2002, the 9/11, 2001, global financial crisis, 2008, the Greek debt crisis, April 2010, Eurozone crisis, 2012, Brexit vote, 2016, U.S.-China trade war, 2019, COVID correction, March 2020, Russia-Ukraine conflict, February 2022. This is an inevitable part of investing and financial planning. And what you need to do is embrace the first principles so you can construct a portfolio that can actually not only get you through these times of uncertainty, but actually take advantage of these times of uncertainty. Because the way you make money long-term in the market is by embracing volatility and having strategies in place that allow you to seize those opportunities that for sure are going to develop along the way. Now, I'm going to cover a listing of strategies that we've used with our clients and continue to use to deal with the noise and the geopolitical events that come along with capital markets, investing, and financial planning. So we'll go through each of them, and then I'll cover them in a little more detail in this presentation. So first of all, construct your financial plan. We think it's critical to have a financial plan. It sets the context for everything, and I'll talk about that in more detail. Number two, be brutally honest with your risk assessment. Every investor and everyone doing a plan needs to assess how much financial risk they're going to take on to achieve their goals. And that's going to be a combination of your financial position, your specific goals and the timelines of those goals, and your emotional or psychological temperament. And you have to be brutally honest with yourself, and your advisor, if you have one, plays a really important role in that particular area. Next, the first 2 points determine your investment and security mix, right? So have a plan that defines the goals, that defines return requirements, assess your risk appetite, and then develop a strategy for your mix. Embrace timeline investing, which we'll talk about in detail. Embrace broad market exposure and diversification. Diversification is not diversification. Diversification is one of the ways that you'll have the laws of probability work in your favor over time in your planning. And embrace active rebalancing in your portfolio. That reinforces the discipline that you need to have through periods of volatility. So your plan basically goes into a number of different components, but you're going to take a look at your retirement planning, you'll do risk assessments, tax planning, cash flow management, and investment planning, of course. And all these things are interconnected, and they provide great clarity in terms of how to construct your portfolio. And these priorities also help you construct your timeline. And what we mean by timeline is every portfolio is going to have a call on it to a certain extent, particularly for retired clients. And so we have timeline 1, timeline 2, and timeline 3. Timeline 1 is money that's going to be needed over the next, let's say, 3 to 4 years. And in that part of your portfolio, you want to be in non-market investments or short-term or short-duration bond ETFs or very low-risk investments like GICs, high-yield savings accounts. Now, when you get to timeline 2, you can take on a little more risk because you don't need your money for another 4, 5, 6 years. But in the investment business, that's not a long period of time. If you get hit with a market correction, you want to make sure that you are taking a moderate level of risk just in case. And then you've got timeline 3, where that money's not needed for 8, 9, 10 years as an example, and you can take more of a growth orientation. Now, your financial plan will help you determine this. This is a snapshot from a financial plan. This is timeline 1. This comes from the report, and you can see that the client has expenses here, and it's telling us how much money they're pulling out of their RSP every year. It could be TFSAs, could be income from their non-registered portfolio. But in this example, this is what they're taking out of their RSP RIF account. Now, this gives us great clarity on how much money we have to have in timeline 1. So if I need to have money coming out at $67,000, $69,000, $71,000, $73,000, I want to have that money in high-yield savings accounts, GICs, maybe short-duration bond portfolios. I don't want to be aggressive with that part of my portfolio. So the financial plan will give us guidance on when money needs to be delivered for income, liquidity, or long-term growth. Now, let's make this really practical. We have the 3 timelines. Obviously, the first timeline's pretty straightforward. Let's say GICs and high-yield savings accounts. Now, timeline 2, the clients agreed that they're prepared to take on some level of risk, and we arrived at a portfolio that was 40% bonds, 60% stocks. This chart's great. It's put together by Vanguard, and it shows us the range of returns for different portfolio mixes. Now, that portfolio mix of 40 bonds, 60 stocks has had a long-term performance number from 1985 to 2023. Average compounded return was 7%. The range of returns in any given year range from 22.7% to minus 18.2% at a maximum. So the client felt comfortable that if they had a 5, 6, 7-year time frame on this portfolio, they would be willing to weather some of the short-term volatility. So that was what we decided to go with. Now, looking at another way, on a 40-60 mix, this portfolio, of course, would be made up of a lot of different asset classes. On the left-hand side, large cap stocks, small cap stocks. We've got global stocks, U.S. stocks, Canadian stocks, fixed income investments. These are all the different investment categories that can comprise the portfolio, and this is from 2000 to 2024. Now what you see is at the bottom here, the white box represents the balanced portfolio. And you can see in any given year, this portfolio tends to track around the middle of the road, and that's exactly what the client wants. They're trying to get better than GIC or savings rate returns, but they want to moderate the swing rate in the portfolio. And that's what they achieve. So over a 10-year average, the portfolio in this model averaged almost 8% per year compounded. And then if you look at all the investment categories as it relates to risk level, it was the fourth least risky asset mix for the client to be involved in. Now, once you move from timeline 2 to timeline 3, you can take on even more financial risk potentially, because it's going to be a long time before you're going to draw on that portfolio. So you can afford to take on more short-term financial risk to maximize long-term performance. The other critical piece to this is that you want to make sure that it's systematically rebalancing. So one of the ways that you can take advantage of market volatility, right? And we're going through that potentially right now. We've definitely gone through it in the past. The way that we coach clients through that was, number one, have securities that systematically rebalance no matter what. And number two, profit take along the way. And number three, if the client has some cash that they don't need in the short term, make sure they use that cash to rebalance into equities in down markets. So our role is to try to enforce that discipline through difficult times, because our belief is that the client will be rewarded for that discipline. Now, in that balanced portfolio example I just showed you, it was using Canadian equities in the example. But obviously, when we construct portfolios, and you should be doing the same thing, you should have broad geographic diversification. So in this example, again, a 40-60 mix, 40% fixed income. We've got an equal allocation between Canadian stocks, U.S. stocks, and global stocks, international stocks. The reality is the U.S. has not always been the best place to invest. And you can see us cycling in and out of global stock markets. And by being able to rebalance between the different categories, again, you could take advantage of anomalies or volatility that can take place geographically. This is a chart that just illustrates the basic point. 2015 to 2024, over the 10-year period, U.S. is the best place to be, for sure. If we look at Canada, it was second best market to be in. If we look at 2001 to 2010, you can see that emerging markets were the best place to be, Canada number 2, U.S. at the bottom. So you want to be broadly diversified and take advantage of the anomalies between each geographic region to try to lever up your performance over time. Now, in the broad scope of things, what we feel is really important is, as you try to maximize after-tax return, focusing on a portfolio construction that does that, particularly for your non-registered and corporate accounts, is really important. That means minimizing taxable distributions through the use of broad-based ETFs as an example. Cost matters. Again, you want to keep those costs for your securities as low as possible, but discipline even matters more. And so it's really long-term discipline, rebalancing through periods of volatility that really drives value. Simplicity over complexity. The more simple your portfolio, the better. Complexity sometimes sounds great, but it usually increases costs in your portfolio and doesn't usually offer additional value. So when we talk about portfolio design, often people want to intervene. In a lot of areas of life, intervention and doing things to fix it is the best strategy. But when it comes to investing, when you go through tough market times and markets are down, trying to fix the problem by trading and doing other things usually makes the problem worse. Concentrate on total return. Don't get focused on a dividend or income strategy or certain perspectives on the portfolio. Focus on total return between dividend income and capital appreciation on your growth portfolio. And connect your portfolio management to ongoing financial planning. So like I said before, owning the broad market is the best long-term way of getting the kind of value that you're seeking in your portfolio. If you get too concentrated in your position geographically or by sectors or stocks, you're going to hit periods of time where you're going to underperform. If you own the broad market, then you'll have a piece of the market that does well. That'll be in your portfolio, so you'll be able to ride that momentum. Well, that summarizes a video that had a lot of ambitious goals, and that was to give you some context for the tariff situation, which is obviously concerning for a lot of people, giving you a little more of a perspective so you can step back a little bit. Hopefully that was helpful. And then going forward, some investment principles that you should be using so that no matter what's going on through geopolitical events or market corrections, your portfolio matches your goals and is positioned properly to take advantage of the volatility. Now again, so you don't miss future videos, make sure you hit subscribe so you get alerted to other videos we're posting on a regular basis. And if you're thinking about your own retirement, go to the show notes. There is a link back to our website where you can find out more information about our complimentary gap analysis and our retirement income planning services. All the best in your retirement income planning.